Welcome to the Real Estate Explainer podcast, where we talk about anything and everything real estate. I'm your host, Brian Kixula. Take notes. Today I'm going to be talking about land allocations. Every day we see real estate investors leave tens of thousands, if not hundreds of thousands of dollars of depreciable basis on the table because they're calculating their land allocations incorrectly. Land allocations involve determining the value of land in order to calculate the correct basis for all other improvements for various purposes such as taxation, insurance, and dispositions. A few weeks ago, a client provided me a depreciation schedule that showed that the CPA had carved out $1,142,877, and they carved it out for the land. The challenge with this is land is a non-depreciable asset. The client bought this property for $1,653,572. That only left them with $357,123 to depreciate on that property. We're able to go in and look at the land allocations and correct the incorrect method and pull back hundreds of thousands of dollars of depreciation for them. So what I want to cover in today's video or on today's podcast is some of the different methods that you can use. One of the most frequent methods and probably the most inaccurate method that we see is a CPA's estimate. So a CPA is using a rule of thumb across the board. On every single property, they'll carve out 20% for the land allocation. The challenge with that is land allocations in San Diego, California are not the same as land allocations in Birmingham, Alabama. They're just not the same. Even in San Diego, the land allocations for a property on the beach in Del Mar are not the same land allocations for a property in Escondido or El Cajon. So you really have to look at that individual property to determine what the correct land allocation is. So this is a valid method, but it could be disputed if you were involved in an audit and your CPA set that estimate too low for the specific area the property's in. One of my favorite methods to come up with the land allocation is simply by looking at the county tax records. There was a court case a number of years ago, the Conroe office building, and what it said, or what the precedent that it said, is that it was a valid method to use what the county lists for the land allocation. And a lot of times the county is going to list it as a percentage of the improved value. So they'll say, okay, the improvements on that property are at 85.3% of the total value. So then you know that 14.17% would be the land allocation. The only thing I would say with this, or my caution would be, is know that this is not always accurate. Let's say that you bought a property that is new construction. The county might not have the correct information yet. So the land allocation that they're going to show on their county tax assessor's records are just not going to be correct. The same thing is if you were to buy a property on a parcel that was subdivided, it may have a land allocation that was for the old building before it was subdivided and the property was torn down and rebuilt. So really look at the different methods to make sure that they make sense for your specific situation or the property's specific situation. However, this is one of my favorite methods to go to, and that would be probably my starting place. Looking at land allocations is looking at the county tax records. I'd like to thank today's sponsor, U.S. Tax Advisors Group, a cost segregation company. To get a free estimate on a cost segregation study, log on to realestateexplainer.com and click the cost segregation link at the top of the page. The next thing that I would absolutely do, let's call it almost a requirement because of the PICO court case, is look at your purchase contract and any of the offering documents from the seller. Sometimes the seller or the realtor will break out the different allocations on the contract or some of their offer letters. They'll carve out the building basis. They'll carve out any business value. They'll carve out all the fixtures, furniture, and equipment, and then they'll list the land allocation. If that is on the contract, then I would recommend using that because of the PICO court case. if it makes sense. Again, it really depends on that individual property, but absolutely look at your purchase contracts and the marketing material to see if they already allocated the land in those documents. One of the IRS's favorite methods is going to be an appraiser's letter. If you could get an appraiser's letter that values your land, that is probably going to have the best authority when it comes to setting your land allocations. The challenge with this is a lot of clients don't go buy a property and then go get an appraisal letter just for the land after they've purchased it. Also, if you're looking at the appraisal that you received when you bought the property, a lot of times the appraisers are just pulling the data off the county records, and that's what they're using for their appraisal. They're typically not doing the cost approach and really looking at the land value by itself. They're not giving that much credit to it. So just note that if the land allocation is on the appraisal, more times than not, they're just using the county records. But if you can order an appraisal specifically for the land, that is probably going to be the best method. So another valid method is to take a look at the replacement cost new of the improvements that are on that property. So let's say that you bought a property for $1.2 million, and you can calculate that the cost to rebuild the roads, all the landscaping, the building, all of the interior improvements cost $1 million, then you know the land is probably worth about $200,000. So using the replacement cost new method is certainly a valid method as well. Another variation of the replacement cost new is to take into consideration any deterioration or depreciation on the property. So you'd say, let's say you've got a building that would cost $800,000 to rebuild. So the building and all of the site improvements is $800,000. But then you look at it and you know that there's depreciation. So you factor in it's going to cost you about $200,000 to make that property as if it was new. So then the building and all the site improvements are worth about $600,000. That's the $800,000 minus the $200,000. You come up with the $600,000. And if you had $1 million purchase price, then you would know that the land value in that case is about $400,000. So really, those are the different land allocations that I recommend using when you're trying to figure out the land allocations for your property that you're buying. And I just want to stress how important it is to really look at your fixed asset schedules prior to filing your tax returns. So look at your fixed asset schedules. Take a look at the way your CPA has calculated the land allocation. Are they using a rule of thumb? Did they take a look at the county tax records, and do those county tax records make sense? You could look at your purchase contract to see if it's already broken out in the purchase contract. And then certainly take a look, is it worth it to get an appraisal letter on the property, or look at the existing appraisal that you have to see if they've already broken it out for you. And then you could start looking at some of the replacement cost new methods. So just want to stress how important it is. I hope this helped answer some questions regarding land allocations, and feel free to reach out to me anytime. Thanks, and I look forward to talking to you soon. If you'd like to get connected with today's guest, log on to realestateexplainer.com and click the Get Connected button on the homepage.